Great. Thank you, everyone, for coming. I want to thank particularly the organizers of this seminar series for inviting me. It's really a pleasure to be here. So my plan for today is to present this work on optimal dynamic insurance contracts, which is an old project that has gone recently through a large overhaul and a set of extensions that I'm very excited to share with you and eager to hear your feedback on. So the motivation for these questions is that most insurance markets in practice are going to be dealing with risks that are recurring in nature. So think of auto insurance, health insurance, and pretty much any relevant insurance market.
I'm sorry,
right?
but your slides just got cut from the right.
Oh, sorry. Is it
now it's better?
Okay,
yeah, perfect. Thank you.
Great. In the presence of these repeated interactions between insurance firms and insurees, what we have is that this raises the possibility of the use of information that is revealed within the interaction of insurees and insurance firms in pricing insurance policies and in determining the details of insurance policies. Now, there is one question here that is important, and that's going to be a crucial part of my paper, which is that there are two separate types of information that are revealed in the course of this interaction. One of those will be exogenous information that is observed directly by insurance firms, and you can think of this as accidents in the case of car insurance, as hospitalizations in the case of health insurance. But firms also have access to endogenous information that's going to take the form of consumer choices. So firms also observe what choices of coverage are made by consumers in the course of their interaction. So this raises the possibility of sophisticated dynamic pricing schemes on the side of insurance firms. And in practice, we do observe in some markets the presence of such pricing schemes in the shape of either driving bonuses, loyalty rewards, or the option of purchasing a premium lock-in, in which case your premium in the future is going to be fixed at a certain amount and be guaranteed to not move up. Now, in other markets, the presence of these dynamic pricing schemes are prohibited by law or regulation. So think, for example, of health insurance markets in the US under the Affordable Care Act, for example, in the health exchanges. So these are markets where firms and consumers are going to be forced to be trading simple short-term contracts in spot markets. But in these types of markets, we still have a long and still active debate on what would be the benefits of allowing firms to write long-term insurance contracts. Okay, and this discussion has to do with the concern with reclassification risk. But for now, let me just postpone this discussion and just say that understanding what the benefits of long-term insurance contracts in these markets is still a very relevant question, even though we don't observe them in practice. And I would argue that this discussion, it's still somewhat incomplete because we don't have an understanding of what optimal dynamic insurance contracts what they look like in the presence of private risk information, except for extreme cases, such as the cases where risk characteristics are going to be totally permanent over time and not change. So the goal of this paper is to study this problem of designing long-term insurance contracts when consumers are privately informed about their risk characteristics, which are assumed to evolve stochastically over time. So the main research questions here will be, as I mentioned before, we have these qualitatively different types of information that are revealed by consumers on the course of an interaction. What role are these two pieces of information going to play in the optimal provision of coverage? The second one is what can we say about the dynamics of coverage and premium over time? In particular, one question of concern is going to be, should we expect the distortions that arise due to private information to disappear over time, or to at least decrease over the course of this interaction? And finally, there is a question of interest, which is the role of consumer commitment. So I'm going to assume throughout that firms can commit to long-term contracts. On the side of consumers, I will start off by assuming that consumers can also commit to long-term contracts. And later on, I'll ask under what conditions the outcome that we obtain under commitment could be sustained as an equilibrium outcome in a model with one-sided commitment, where consumers do have an option to re-enter the market to obtain new insurance contracts. Any questions so far?
Yeah, I have one. So you say you're studying the profit maximizing contracts. So is efficient contracts not interesting or trivial? Or so if you want to think about regulation, it might be interesting to know what efficient contracts are.
That's a good question. So for efficient contracts, at least if we're just looking at ex-ante aggregate fair or maximizing the ex-ante utility of consumers prior to knowing even their initial risk level, the first best is going to be trivial in that you're just going to offer complete coverage to everyone at a fixed premium that's going to be the actuarially fair premium given the overall risk distribution in the population. Now, if you want to for some reason discriminate what utility you're going to offer to utilities that have initially high risk versus low risk, then things would get more complicated. But that's a good question. I imagine the characterization here would still tell us something about the optimal long-term contract in that case. So just to be clear, what I mean is, if for some reason you have different Pareto weights on agents that are initially of high risk and low risk, as long as you want to, for some reason, offer different continuation utilities for these different initial types, the types of distortions that I'm going to be describing here are still going to be present in the optimal long-term contract. That's a good question. I haven't thought that deeply about this question. So in broad strokes, what are going to be the main results? So I'll present a characterization of the optimal mechanism in this environment. And in short, consumers are going to have an option between an efficient continuation contract, which means in this environment is going to be obtaining complete coverage with a constant premium. So consumers are going to have complete consumption smoothing across possible different accident realizations and also across different periods. And a contract with partial coverage, which in this environment means that we have the presence of distortion. Now, what happens with these contracts as time goes by? So if consumers choose partial coverage, okay, then they're going to obtain future offers that are going to be more attractive. So this means is they're going to be generating higher flow utility to consumers, and they're also going to be less distorted, meaning they're going to be providing more coverage to consumers. So this is due to the fact that the choice of partial coverage in the optimal mechanism is going to be taken as a signal that agents have low risk, and hence going to be rewarded with more attractive future contract terms. So under a mild condition on preferences, at least I'd like to argue that it is a mild condition on preferences. We can discuss this later on. So as I mentioned, I actually need a mild condition on preferences in order to show that the optimal contract is going to feature decreasing distortion. So the partial coverage policy that is offered to agents is going to have increasing coverage over time. Okay, so the result of this characterization applies to both the extreme cases of perfect competition and monopoly, as you see. And I imagine that even though I haven't explicitly characterized the case of imperfect competition, as you see, some of the insights of where the dynamic distortions come from in this model are going to be, obviously more general in these two extreme cases that I'm going to be discussing. And the results extend to model one-sided commitment if the bad state in my environment, which you can think of it as being of high risk, is an absorbing state. So this means if it is the case that once agents become sick, they stay sick, or they develop a condition that's going to be permanent and they can't recover and become healthy again, then the optimal contract with two-sided committee is in fact robust to the possibility of exit on the side of consumers. Okay, so unless there are questions, I'll give you at least some of the ingredients of the model so we can talk about results. So we're going to be looking at a consumer that has a stream of income that is risky. So we're going to be modeling the presence of risk as coming from income losses. So in each period T, consumers are going to have an income realization YT that comes from a finite set capital Y. Now, the distribution of these income realizations is going to be dependent on an underlying risk type, which I'm going to call theta T, that can be either low or high. Okay, and we're going to be calling here a high type, a type that is going to be more attractive to firms. So this means is that the high type is going to be one that has a higher expected income within a period. So within each period, agents are going to have a distribution over possible income levels that depends on their current type. And an agent with high risk is going to have a higher expected income versus an agent with low risk. Sorry, a high type agent is going to have a higher expected income than a low type agent. And I apologize if this is confusing, but you should think of the high type as the equivalent of a low risk. It's going to be an agent that has a lower probability of a loss. Okay, but from now on, I'll be referring just to a high type or low type. Now, these risk levels are going to be, a crucial part of the analysis. They're assumed to follow, a Markov process, a first-order Markov process. So we're going to refer to pi ij. This is the probability of transitioning from type I to type J, okay, from one period to another. Now, I'm implicitly already assuming that we have a stationary Markov process here, since these transition probabilities do not depend on explicitly on time t. Now, the assumption of stationarity is actually not important for the characterization, even though it simplifies the notation a lot. Now, what is important for the analysis, as I'll argue throughout, is that I assume that this process has persistence. So what this means is that it is more likely that it will be type I tomorrow if I'm a type I today versus being a type J today. Any questions so far? Both consumers and firms discount the future with same discount rate delta, and consumer has strictly concave Bernoulli U. So consumers are simply going to be maximizing their discounted expected utility when deciding either to take an insurance contract or not, or how to behave within the course of a particular long-term contract. So CT, I'm going to be using that to represent the net consumption obtained by the agent within each period T, taking into account both the original income that this agent has, minus any losses that this agent might have, minus any premium that is paid by the agent, plus any coverage payment that the agent receives from the insurance company. Insurers, on the other hand, are going to be maximizing the discounted expected net payments received by the agent. Okay, so take into account both premiums and potential payments that are going to be made out to, payments related to coverage made out to the agent. Okay, so now let me talk about contracts and mechanisms here that they get a little bit involved. So let me start from the basic building block of a mechanism in this model, which is the equivalent of a static insurance policy. Okay, so I could describe a static insurance policy as being defined by a premium and a predefined coverage for every potential loss level that this agent might incur. It's going to be more convenient to describe flow contracts as simply determining directly what's going to be the final net consumption of the agent. So it's going to be a mapping from the set of possible income realizations to the non-negative real numbers that determine for every possible income realization what's going to be the consumption of the agent. Okay, so now what are going to be then dynamic or long-term contracts in this environment? They're going to be a sequence of flow contracts or policies whose offer or provision is going to be history dependent. So the flow contract or the policy offered to the agent in each period T is going to depend on a history of observables of that the firm has access to up to period T. Now, what are exactly these observables? Okay, so I'm going to be introducing this object phi, which is a signal function, and the role of this signal function is to incorporate the fact that firms may not be able to explicitly use information about past accident realizations or income realizations in this environment when pricing contracts. So the underlying assumption here will be that firms cannot directly, the offers made at period T cannot directly depend on the history of realizations of income, Y superscript T, but it will depend on the sequence of observables or signals, which is going to be this phi function applied to income levels YT. Okay. Now, what does this mean? So there are going to be two special cases, at least, that we're going to be interested in. The first one is the case where this phi function is just the identity function. So this is the situation where firms can directly make contracts directly dependent on the history of accident explicitly. So that would be one extreme case. In the other extreme, we have the situation in which this phi function is a constant function. And this is just a convenient way of writing the situation in which firms cannot use explicitly the accident history on pricing at all, which is a common restriction in insurance markets, at least for health insurance markets. So the signal function is a convenient way of putting these different cases into the same more general problem. So this phi function, just to be clear, this is not going to be a choice of firms. It's just going to be an extra parameter of the model. So in each period T, firms are going to be offering a set of options, a set of flow contracts to the agent that are going to depend on the choices of the agent up to the current period, which are going to take the form of a set of announcements, because I'm going to be looking at direct mechanisms, and also on the set of signals observed all the way to last period, to period T-1. Okay, so a history of signals and choices or announcements will be denoted as eta superscript T. So this would be a good moment to pause for questions as well.
I suppose this will going to be on the next slide, but I was wondering whether the agent can misreport Y. So I'm thinking about car insurance and I hit someone and then I decide whether I pay it myself or go to the insurance.
Right. So the agent cannot misreport Y. So the agent can potentially only misreport their risk type. Okay. So this is actually an interesting question, because there is this this old and still active literature more on the macro side that looks at dynamic insurance problems where agents have private information with respect to the underlying endowments. So this would be more similar to the situation you're referring to, where agents might misreport their endowment within a period. Here, I'm coming more from the the standard competitive insurance literature, where we're thinking of asymmetric information about risks. But absolutely, having both of them would be interesting. But I'm looking at I'm just isolating private information with respect to risks and not endowment. So it might be easy to understand what a mechanism is if I just we go through what the timing of events within a period will be like. So I can restrict attention to direct mechanisms. What this means is that within each period, an agent is going to simply be revealing its own type, theta T, and I can restrict attention to mechanisms that are incentive compatible and to truthful equilibria of this truthful equilibrium, which agents report their types truthfully. Now, let's assume that this firm and agent are already in agreement. There's already a long-term contract that has been agreed upon. And let's just zoom in on a particular period and see what will the timing look like within, once we are already in a particular mechanism. So in each period T, the agent will start period T, carry over a set of histories from all the way up to last period, which is going to be represented by the set of signals observed up to last period, and the set of reports up to last period, theta hat. Now we arrive in this period, so we're going to have a new type realization with theta t is going to be realized. And this agent is going to observe theta t and report theta t. So we're going to have theta hat t. Then the income realization yt is going to occur. And the flow contract from period t is going to be executed. So what does this mean? So the flow contract that the agent is going to receive in period t is going to depend on a whole history of signal realizations up to period t-1, so everything that was directly observed by firms up to last period, on the history of announcements, including this period's announcement, so it's a history all the way to period t. Now this determines the flow contract received by the agent in the current period. Now if this contract gets executed, this means that the final consumption of the agent will be this contract applied to yt, which is the current period income level. And then once this consumption is obtained by the consumer, we move to the next period, and in the next period, the new history is going to be the history of signals up to period t-1, plus a new observation, which is going to be the signal connected with income realization yt. And now we have an expanded history of announcements that includes the period t announcement as well. Okay, so hope this clarifies a little bit what mechanisms look like in this model. Vitaly, you look a bit puzzled.
No, I'm fine. I was just thinking about real-world equivalents, but then I kind of made the story in my head, so just go ahead.
Okay, great. Okay, so let me describe the problem that I'm going to be looking at. Okay, so within a particular mechanism M, we're going to call capital V. This is going to be the expected continuation utility of a consumer within mechanism M. Particularly, we're going to be talking a lot about the continuation utility of the agent within a mechanism conditioned on its initial type, theta 1. Okay, because they're going to be the underlying assumption here is going to be that consumers get to contract with firms, and they already know their initial risk type when this contracting between firms and consumers occurs. So we'll be looking at a problem, okay, a profit problem that's going to give us a profit function pi, which is going to be conditional on a pair of continuation utilities that are supposed to be delivered to the agent on the course of the mechanism. Okay, so this VL and VH, these are going to correspond to the expected continuation utility for an agent that is initially of low type or high type. And we're going to be studying the problem of choosing the optimal mechanism that delivers this pair of utilities. Okay, so what this means is we'll be considering a profit maximization problem where we have our usual standard incentive compatibility constraints, and we have some promise keeping constraints. That means that this firm should offer a contract such that the initial expected utility of the agent condition their initial type needs to exactly match up to these V's that are specified in the profit maximization problem. And I'm going to be studying the solution to this problem when we want to offer a higher initial utility to an agent that has a high type versus a low type. So the idea behind looking at this problem is that this gives us a way of studying the optimal provision of incentives without, at this moment, taking a stance of where these pair of utilities come from. So you should think of it as, in the end of the day, we're going to close the model, and there's going to be, when we close the model, there's going to be a way of determining what is going to be the equilibrium utility levels obtained by the agents that have high versus low risk. Now, under a wide class of models, it's going to have to be the case that firms offer cost minimizing contracts within the class of contracts that deliver this set of this pair of utility levels. Okay, so I'm going to take as given for now that for some reason firms want to offer higher utility to an agent that has a high type versus a low type, and study what's going to be the efficient way of providing these utility levels. And later on, I'll argue that this is indeed going to be the case when we look at either the equilibrium of competitive model or when we look at the monopoly environment. What turns out to be quite convenient, and it might be not that surprising to most of you, is that this profit maximization problem has a recursive structure. Which means both the set of feasible utility pairs has a recursive description, and also the the maximal profit function has a recursive structure that's going to be exploited to obtain a characterization. And the way in which the solution, obtain the solution to this problem is going to be somewhat standard in mechanism design literature, which is in that I will look at a relaxed profit maximization problem and then show that the solution to this relaxed problem indeed satisfies the original incentive constraints of the original problem. Now, the relaxed problem is going to be one where I only take into account one-shot upwards incentive constraint. So this means if agents of a low type in a given period pretending to have a high type for one particular period and otherwise report truthfully their types. Now, once again, as standard in a mechanism designed to make this jump from a relaxed problem to the original problem, we're going to have certain monotonicity properties that are going to be important. Now, differently from a static environment, now we're going to have three sets of monotonicity properties that I need to guarantee in order to make this transition from the relaxed problem to the original problem. The first one is going to be quite similar to what we would have in the static environments, which is that a certain monotonicity property that, in short, just means that agents with high risk must be more exposed to risk than low risk agents, and this risk exposure must take place in a very in a very particular way. Now, we also need to worry about how future contract offers made to the agent are going to depend on what happens on today's interaction. So these are going to be what I call the continuation monotonicity properties, and they have to do with how the continuation utility of the agent within a particular mechanism varies with both the announcement made within the current period and also what's going to be the signal observed by the firms within the current period. So in the case of, one extreme case would be when firms can directly use and observe the history of accidents of the agent on how the future expected utility of the agent depends on the current period realization of an accident. So I won't get into exact details on what these monotonicity properties look like. I just want to say that one of the contributions here is to come up with a set of monotonicity properties that are going to be useful to connect this relaxed problem with the original problem, and they're described in a way that allows us to leverage this recursive structure of this profit maximization problem. Okay, so what do optimal mechanisms look like? So what can we say? So the first one is we're going to have efficiency at the bottom. So we're going to be, the binding incentive constraints here are going to be of low type agents pretending to be high type. So this means low type agents are going to have efficient continuation contracts. In this model, what efficiency means is that agents are going to be obtain full coverage at a constant premium, okay, following an announcement of a low type. So in other words, if we look at a history of signals and type reports that involve only high type reports up to period T-1, and then in period T, the agent announces a low type, and this agent is going to receive full coverage from this moment onwards, and the premium paid by this agent is only going to depend on the history of signals up to period T-1. So when I choose to report a low type, not only I receive full coverage today, but I'm not exposed to any risk as it comes to the future contract terms that are going to be offered.
I have a question, well, maybe you will answer that again shortly. So is that something that, I'm not familiar with insurance models. So is it something we would expect from an insurance model? Because usually we'll have no distortion at the top. Is that coming from the insurance or from the dynamics?
I would say this is not too surprising, and that's typically, in binary problems, we're going to have, efficiency in one of the two sides. And here, efficiency is not going to be just from a static perspective, it's going to be from the perspective of continuation contracts. So this is not, you shouldn't think of this as a very surprising outcome. So I'm going to be more interested in how the partial, on the side of this tree of type realizations that we have partial coverage, what do these partial coverage contracts look like? Do they become more attractive and do they have more or less distortion? And that's also going to allow me to say something about how these full coverage contracts that are offered to the agent as well, how those are going to change over time. But the fact that we have efficiency following a load type announcement, that's not particularly surprising. Okay, now when we do, so now let's zero in on the, on histories where we do have partial coverage. What would these, contract offers, what would these flow contract offers look like? So not surprisingly, from contract theory, we know that when we're trying to screen agents in a cost minimizing way, we're going to make use of likelihood ratios. So I define the likelihood ratio L to be the ratio of the probability of observing a certain income realization coming from a low type agent divided by the probability of the same income realizations coming from a high type agent. So this means that we should think of a high L as having been an income realization that is indicative of a low type. So those are going to be ones that are going to be, they're going to be punished, or the agent is going to have lower consumption and utility. And we can extend the same definition more broadly to signal realization. So for any signal, you can calculate the likelihood ratio, which represents the ratio of the probability of it coming from a low type versus a high type. Now, when we look at the flow contracts, the first thing is that they're going to have efficient provision of incentives within a period. So what this means is we're going to reward the agent based on this likelihood ratio, meaning that within a period, if we look at realization of income that is indicative of a low type or has a high likelihood ratio, that's going to be connected with a lower level of consumption delivered to the agent. So this, once again, this would be also the case when we look at a static screening problem of static insurance screening problem. So it's not something that is particular to the dynamic environment that I look here, but it's just going to be important when we talk about the moving from this relaxed problem to the original problem. Now, what is going to be more interesting in the dynamic environment is when we look at what happens in period T, meaning the announcement made in period T and the income realization in period T, how is this going to affect the future contracts offered to the agent? And I'm going to be, one way of summarizing how the future contract offer made to the agent are going to look like is to look at the continuation utility of the agent within a particular mechanism. So first, let's look at what will be the future impact of the type announcement in period T. Okay? So it turns out that if we look at histories in which this agent is still exposed to risk, an announcement of a high type in period, an announcement of a high type, sorry, we're going to be looking at period T+1. So but let's look at period T+1, what's going to be the continuation utility from this period onwards. Then an announcement of a high type in period T+1 is going to increase the continuation utility of the agent in the optimal contract. Now, we started with this, an assumption that the original utility offered to an agent of a high type is going to be greater than that of utility with an initial low type. What this result says is that this utility gap is going to be propagated into future periods. So it's going to be the case that also in periods greater than 1, agents that are announced to have a high type are going to have a higher continuation utility versus an agent that announced to have a low type. The reason for that, it also follows from this likelihood principle that I've referred to before, which is, it's also related to the persistence assumption of the type process. Because types are persistent, this means that having a high type in period T+1 is indicative of having high type in period T. So in particular, these firms are trying to reward, because I want to offer a higher utility to an agent that is initially of a high type, I want to reward any information that's going to be indicative of the agent have an initially high type. So because of this persistence, having a high type in any future period is going to be indicative of having a high type in the initial period, and it's going to be rewarded as a consequence. The second statement about continuation utility is going to be that we will also, we will also use the signal realizations observed in period T in order to reward the agent in future periods. Okay, so what this means is if in period T we observe a signal realization phi prime that is indicative of a low type that's more likely to come from, that's relatively more likely to come from a high type. Sorry, let me rephrase this. So if we observe a signal realization that is indicative of a low type, which means that it has a high likelihood ratio, then not only this agent is going to have lower consumption today, that comes from a characterization of flow contracts, but also you're going to be receiving less attractive contracts in the future. So it's going to have a persistent effect on the utility of the agent. So what this means, if we look at the continuation utility from period T+1 onwards, okay, this continuation utility is going to be lower if an agent has this signal realization phi prime compared to signal realization phi. Okay, so once again, coming from this no likelihood principle that I want to punish this signal realization phi prime, and the optimal way to do this is going to be not only to give the agent less consumption today, but also punish the agent with lower continuation utility in the future. Any questions?
So
okay, so
quick question, if I may. So if you could just say a couple words about how that ties in with the full insurance in the case of the low type. That was one of your first results.
Mm-hmm. Right. So this, I don't know if this is exactly what you're asking, but this result here will only apply to histories where the agent is exposed to risk. So I'm zeroing in now on histories that only involve high type realizations. But basically, I'm saying, whenever you have a low type, you're going to be locked in. You're going to have free insurance from this moment onwards. So now I'm just saying, if I look at the remaining histories in which you do have distortions, what will those look like? Does that answer your question? Great. So I should have clarified that. So once again, coming back to this point, what I've given you now is a picture of when are we going to have partial coverage versus full coverage, and when we have partial coverage, I gave you some characterization of what this partial coverage will look like. So when we look at the trio possible type realizations, what happens within particular period is that so the red region here represents the possible paths in which the agent is going to have partial coverage. So if the agent has, so in each period, the agent either has a low type, in which case this agent is going to be, getting a fixed consumption level, which depends on the history of signals up to period T-1, or this agent is going to announce to have a high type, in which case this agent is going to be exposed to risk within period T, but also the set of future offers made in period T+1 will depend on this, also on the signal realization in period T. Okay, so in period T+1, this agent once again will have the option between announcing to have a low type and getting a constant consumption. That now depends also on period T signal realization, or continuing to have partial coverage. So now what I'll do is, in the time that remains, is to try to tell you something about how can I quantify somehow what happens to partial coverage along these histories in which the agent is exposed to partial coverage. And this is also going to be useful to say something about what do the consumption levels of the agent when it chooses to have a low type what are those consumption levels going to be? And can we compare in some sense the consumption level of the agent if choosing full coverage in period T versus in period T+1? Should we expect an agent that chooses partial coverage earlier on to get better or worse terms versus an agent that chooses to get full coverage later on? So to study the dynamics of premium and coverage in this model, which is the question I just referred to, there are going to be two technical challenges that I'd like to highlight, and that are they're going to be of a different, that is what are going to help us understand how different this problem is from the standard dynamic mechanism design problem studied in the literature. The first one is the presence of risk aversion. So, most of the literature in dynamic mechanism design focuses on quasi-linear environments. So the presence of risk aversion means that when we're looking at the cost of screening, which means that if I want to offer different utility levels to agents with different types, this is going to require exposing the agents to risk or introducing distortions, which means that to offer the same utility level to the agent is going to cost more for the insurance firm now. So it turns out that the marginal cost of screening or separating agents with different types is going to be dependent on the utility level that are offered to the agent. So there is a certain non-separability here of these two costs in this problem that's going to be important for us. The second one is the fact that the flow allocation problem, or flow contracts, are going to be multidimensional in nature. Okay, so while in the standard screening problems, we typically have agents are going to be offered a quantity of consumption and a transfer. And in that case, distortions can be directly mapped to either under or over provision of consumption. And here, a flow contract is simply a set of income contingent consumption levels. So it's not that clear what does it mean for a contract to be more or less distorted. So first challenge here methodologically is to even try to think of what exactly are distortions here. Can we find a one-dimensional variable that's going to correspond to some measure of distortion in this environment? So to do this, to solve these two problems, I construct an auxiliary static cost minimization problem that's going to be, that's going to represent a small part of the dynamic profit maximization problem that firms are solving. It's going to be useful for us. So what is this static problem? So if I look at, within any period t, let's think of a flow contract that is offered to an agent that's of high type. This flow contract will have to achieve two objectives. So the first one, it's supposed to deliver a certain flow utility to the agent, which I'll call nu, and is also supposed to provide a certain punishment within period t for an agent that's of a low type and pretends to be a high type. Okay, so this punishment is going to be represented by this variable delta. So this means is a low type agent that pretends to be a high type should not receive exactly nu, but should receive nu minus a certain punishment delta. Okay, so why is this going to be so what I'm doing here is I'm essentially going to be finding a way of representing flow contracts as being described by these two objects, and they're going to be useful because we can think of this new variable as representing the attractiveness of the flow contract offered to an agent within a period. And the delta is going to be directly connected with the amount of distortions on the contract that is offered to the agent within a period. So if we think for a second of the situation where delta is equal to 0, okay, if I want to offer the same utility level to an agent that's of a high type or a low type, I can do this by offering full coverage to the agent. So if I completely insure the agent, then an agent with low risk and high risk, they're both going to get the same utility from this flow contract. If I want to introduce a wedge in the flow utility offered to these two types of agents, that's when I'm going to have to expose the high risk agent to risk, because that's the only way of discouraging low type agents from pretending to be a high type. Okay, so I'm going to be assuming, so as I said, the non-separability problem comes from the fact that this function here is not going to be, if I look at the marginal costs coming from this auxiliary cost function, they're not going to be separable when it comes to both the flow utility nu and the distortion level delta. So I'm going to be, assuming throughout that we are in this, well-behaved case, which is where this cost function is supermodular. So this is saying that the marginal cost of separating agents in terms of utility is going to be increasing on the utility level that I offer to the agent. Okay, so if I have time, which I'm not that optimistic on, but I have primitive conditions on, this is just a condition on prefaces on the Bernoulli utility function that essentially say that the absolute risk aversion of the agent cannot decrease too quickly with the consumption level of the agent. So it includes a constant absolute risk aversion, for example, or constant relative risk aversion with the parameter that is greater than, with the relative risk aversion greater than 1/2. So how am I going to use this auxiliary problem? Okay, so what I'll be doing is I'll be dividing the problem of designing a long-term mechanism in two parts. So the first one is, I would decide how exactly I'm going to be spreading out the delivery of utility, how I'm going to be choosing the flow utility levels that I'm going to be offering to the agent within each period, and how I'm going to be spreading out the distortions in this optimal contract, how much I'm going to be distorting the contract within each particular period. Now, for any particular flow utility and flow distortion within a period, these firms are going to have to offer this, this pair of utility and distortions in a cost minimizing way. So in the optimal mechanism, in each period T, the contract that is offered to the agent, the agent that has consecutive announcements of high type, that has partial coverage, is going to be one solution to such a cost minimization problem. So I'm going to call zeta the solution to this auxiliary cost minimization problem I described for an appropriately defined flow utility VT and flow distortion delta T, which are going to be exactly, they must be the ones that are going to be arising from the optimal dynamic mechanism. Okay, so and this flow, once again, this flow utility and flow distortion can depend on the history of signals observed all the way to to period T-1. So what I'll do is I'll turn the problem of finding the optimal mechanism into a much more tractable, convex, dynamic cost minimization problem, where firms are choosing directly what flow utilities and flow distortions to provide to the agent in each period. So these firms are explicitly deciding how to spread out the delivery of utility and how to spread out the delivery of distortions in this contract. So if I want to offer a higher utility for an agent that's initially of a high type versus a low type, I can do that by distorting a lot the contract of the agent in the first period and offering full insurance in the second period. Or I can also offer contracts that are going to be distorted in the second period. So it turns out that the optimal cost minimizing way of doing that will be somehow to spread out distortions over time. So, looking at zeroing in on this cost minimization problem, I'll obtain a characterization of optimality in terms of marginal costs that are going to tell us, how the marginal costs of flow utility and flow distortions evolve over time in a cost minimizing mechanism. And I've already argued that this flow utility nu and this distortion delta, they have a direct interpretation, which is going to be the attractiveness of a contract within a period and the amount of distortion in a contract, a flow contract offered to the agent within a period. But if we look at the marginal costs coming from this auxiliary cost function, they're also going to have a direct interpretation. Okay, so if we look at the marginal cost of flow utility nu, okay, so let's look, for example, the log utility case, which is going to be the one that's most intuitive. So if we look at the marginal cost of flow utility nu, and this is going to be increasing the flow utility nu itself because the cost function is going to be convex, this is going to correspond to the expected consumption of the agent within the flow, within a period, connected with the flow contract offered to the agent at that period. And if we look at the marginal cost of distortions, which is going to be increasing with the level of distortions because of convexity, this is going to be not equal to, but it's going to be proportional to the variance of the consumption profile of the agent within a period. Now, these exact forms of expectation and variances, they're going to be particular to the log function. But in the paper, I have a general characterization that shows that the marginal cost of flow utility is going to be directly connected with some notion of the overall level of consumption that this agent has within a period. and the marginal cost of distortion is going to be connected with some measure of the amount of dispersion of consumption that this agent has within a period. Okay, so if I can say something about how these marginal costs evolve over time, this is going to tell me something about what happens to the consumption of the agent over time and indirectly with premium, and what happens with the dispersion of consumption of the agent over time, which is connected with the amount of coverage of the agent. So let's look first at the case of realization-independent contracts, which is going to be the extreme case that I mentioned before, where this phi function is constant. So what this means is that the contract offered to the agent within a period will only depend on the history of announcements up to that period, and it doesn't depend on the history of income realizations at all. So this is useful because obviously this is going to be the simplest case to look at, but also because this is the case that's more comparable to what we have in the standard dynamic mechanism design literature, where the only source of information that we have over the course of a mechanism is coming from the announcements of the agent. So this is the underlying assumption in this extreme case. So in here, if we look at the, partial coverage contracts that are offered to the agent along the paths in which the agent gets partial coverage, they're connected with high type announcements. Those are going to be dependent on these, flow utilities nu and flow distortions delta that now are only dependent on time. They don't depend on the history of income realization. So main result in this case says that if we look at these partial coverage contracts, they're getting more attractive over time. So this means is the flow utility of these partial coverage contracts is going up, and also the marginal cost of flow utility is going up over time. So these two things will be connected. So if we think about the log utility case, for example, if I look at the expected consumption of the agent within a period, this is going up if we're looking at the partial coverage contracts offered to the agent. So they're becoming more attractive, which comes from the fact that consecutive high type announcements are going to be rewarded because they're thought of as a signal of a high type. And second, these contracts are getting more efficient. So if we look at the flow distortions within these partial coverage contracts, those are becoming smaller, and the marginal cost of flow distortion is also becoming smaller over time. So if we look once again at the log utility case, this is saying that the within period variance of consumption of the agent is going to be decreasing over time. So these agents are obtaining more coverage. If we look at the case of realization-dependent contracts, so now let's look at the general case where firms can potentially use the history of income realizations of the agent when determining flow contract offers made within a period. And now, for the case of realization-independent contracts, I'll focus on the case of 2 periods. So it turns out that an analogous, a proper generalization of the previous result holds in this case. Now, the main difference will be that when I'm comparing the partial coverage contract in period 1 versus period 2, these contracts are going to be the period. I saw, Vitor, that you raised a paper. I couldn't actually see what on the paper, but I had 5 minutes to go. Yes. So is that the second period contract now is going to depend on the first period signal realization observed by the firm. So if firms can directly contingent contracts on income realizations. So now the second period partial coverage contract is going to be random. It depends on the first period income realization. So what I can say is I can compare the marginal costs in period 1 with the expectation of the marginal cost in period 2, where we're taking average over possible signal realizations. And I can say that the marginal cost of flow utility in expectations goes up if we're looking at these partial coverage contracts, which means that in expectation, if I look at the log case, for example, in expectation, the average consumption of the agent is moving up along this partial coverage path. And also, if we look at the marginal cost of distortions, the marginal cost of distortions is going down in expectation. So if we look at the dispersion of consumption within the flow contract of the agent, that is reducing over time in expectations. But of course, the exact contract obtained in the second period will depend on the income realization of the first period. So for some particular income realizations, it could be the case that the contract offered in the second period is going to be worse in terms of flow utility and is going to have more distortions. So in an appropriate sense, these partial coverage contracts are becoming more attractive and less distorted. So I have 3 minutes, so let me skip this slide and say a few things. So I've said a lot of things about what happens to these partial coverage contracts over time, but it turns out that allowing me to say something about the partial coverage contracts that are offered, how they change over time, also allows me to characterize what is happening to the full coverage contracts offered to the agent. This is due to the fact that we're going to have certain binding incentive constraints in the optimal contract, which means that the low type agent is going to be indifferent between announcing to have a low type and get full coverage, or announce to have a high type and getting this partial coverage contract that is offered to the agent. So characterizing the partial coverage contracts allows me to also say something about what happens to the premium of these full coverage contracts that are offered over time to the agent. So if we look at either the case where the bad state is absorbing, which means the transition from low to low is as probability 1, where we have an infinite horizon, then it turns out that the full coverage contract offered to the agent becomes cheaper over time. So if you choose partial coverage in period 1, you're going to get a worse contract with higher premium than if you choose partial coverage in period 2. It's coming from the fact that choosing partial coverage later on is also indicative of a high type. So the implication is that the utility flow in the optimal contract is going to be backloaded in some sense. So these contracts are all getting more attractive over time. So an implication of this is going to be that in these cases, the contract that we obtain from the full two-sided commitment case is going to be robust to one-sided commitment. So this comes from the fact that the optimal contract is going to be naturally backloaded. So just the fact that we have private information on risk characteristics pushes these firms to offer backloaded contract, which automatically solves the potential problem of having one-sided commitment, of not having commitment on the side of consumers. So I have 1 minute or less. So let me just say that these results apply to both the competitive model and to a monopoly model, and conclude by saying that the goal of this paper is to extend some of the tools that we have from the dynamic mechanism design literature to study a quite natural dynamic extension of our classic workhorse problem of dynamic insurance with private risk information. So it highlights how the optimal mechanism will use both endogenously and exogenously generated information that arises on the course of the mechanism. Under the supermodularity property of this appropriately defined cost function, we show that distortions are going to decrease. So these contracts do become more efficient over time. And I would like to argue that this methodology and the way in which this problem was solved is applicable to other dynamic mechanism design problems with curvature. So one problem that I'm interested in, where I think that this characterization is going to be useful, will be looking, for example, at standard buyer-seller models where buyers have curvature. So buyers have curvature in the utility function, which means that they do care about the spreading of payments or consumption over time. Okay, so I'm going to stop here and just thank everyone for coming.
So thank you very much. You can take questions now. So whoever wants to stay, stay. Whoever wants to leave, leave. But before you leave, hear the following. In 2 weeks, we'll have another speaker who is Alan Muir from the Harvard University. And Vitor is going to stay on. So if you have questions regarding the talk, please. I have one.
Yes.
I was just thinking, I mean, this is probably this is your last result. So the absorbing type, that would be, I'm thinking about occupational disability insurance, for example, which is a big thing in Germany. That once you have a kind of the accident, you get out the payout as a one-time thing. So that would be a case where the kind of it's absorbing, maybe. And the kind of on the other hand, it would be, I don't know, car insurance that I could switch once a year. So what would your model say about this? And the third factor, just giving you some thoughts, is what we see in those contracts is that I thought of them as front-loaded. That I pay a lot over my lifetime, and it's really expensive to abandon this contract at some point because then I have to start over somewhere. But you say they are backloaded.
Okay, so
maybe you got something.
So I think that you're referring to they're front loaded in terms of the payments made by the agent. So meaning that they're more attractive. I don't want to abandon them later on. So this is in line what I'm referring to. I use the backloaded in the sense that the utility of the agent is backloaded. So it's in line with what you're saying. The payments are going to be front loaded. The first thing, just to clarify, I use backloaded. I don't know if it's too precise, but in the sense of the utility dispersion of the agent. So these contracts are becoming more attractive over time. So this is in line with them becoming less expensive over time. Now, on the question of the dynamics of the type process, first of all, disability insurance is an interesting example that I hadn't thought about at all. I think maybe because it's a less prominent kind of market in North America. But it seems like a good example. So thank you. I'll think more about that. I think the permanent negative shock in that case makes a lot of sense. Most of the intuitions I have to do with health insurance. So I think of the, you develop a heart condition or diabetes. This would be, for example, the transition to the low state that's going to be permanent. You're going to need just more treatments on average for a longer, for the rest of your life. For car insurance, it's less clear to me what the right intuition is. I mean, I do imagine there are certain aspects of your risk level that are not going to be permanent, that are going to be varying over time. And, you should think of the IAG case as being a knife edge case, right? So I should think that there is some correlation, some time correlation on this process. Now, is this process persistent or not? I'm not really sure. I don't have a clear intuition as to why this is. So the primary private information aspect of car insurance would be whether I'm a good driver or a bad driver, or whether I'm careless or careful. I don't think of this as particularly changing over time. I think of this as more of a permanent aspect of the risk characteristics. So that's why my intuitions for car insurance are less clear.
I mean, I could lose eyesight with time, or I don't know, I get children that are on the back seat and I'm distracted suddenly that all of the time I'm driving. That happens. So I can tell you about that. So
that's right. And I guess the persistence there is that, if you have children, they're going to stay around for a few years at least, increasing your risk of an accident.
I was thinking whether we can kind of create commitment with the contracts. I mean, obviously, I don't understand it as deeply as you. But here is kind of how private health insurance works in Germany. So we have a state health insurance and we have a private system. It's kind of a dual system. Some people are private, some are state. And the private health insurance, basically you start off with a low premium and then the premium increases over time, but you have an account where they collect the money that you paid into the insurance. So if you switch private insurance later in life, it becomes way more expensive than with your current provider because they don't have I don't know what's the proper term for that, whatever they created in your account. So there is kind of a commitment, even though you can switch insurance products all the time, there is kind of some commitment in it because I don't want to switch because everything that I could switch to is way more expensive. Maybe, I don't know, can you explain something like that?
Right. So I haven't explicitly looked at that case, but my interpretation is the following: that I'm mainly looking at the stationary case. So what this means is that, let's think of the infinite horizon case at first. So what this means is that for a fixed type, if you're a high type in period 1, or if you're a high type in period 10, your continuation expected utility is going to be the same. So you should think of it as your actuarially fair outside option should be the same, should not vary over time. And the result here is that the contract is going to be backloaded. So relative to that, your optimal contract is getting more attractive. Your originally obtained contract is getting more attractive. Now, this seems to be somewhat in line with what you're saying, which is that when we're looking in reality, we don't have stationarity, right? So we have some kind of persistence, but agents are getting riskier over time, just in a deterministic sense. So even though their premium is going up, it's not compensating exactly for their risk increase over time. So they're getting, in terms of their continuation utility, they're getting subsidized. So relative to their outside option, they're staying in the original contract is becoming more and more attractive. So I would imagine that would still be the case, that the relative to what you get in the outside market, your original contract would get more attractive over time. But I don't exactly have a characterization for that case. All I would say is that in a model with stationarity, it is true that it's becoming more and more costly for you to leave the contract. Now, the only difference here is that to leave the contract is going to be, the outside option is going to be constant in a stationary environment. And in practice, that would not be constant.
Okay. Oh, interesting.
I'm trying to think, what else can I say about that? So in fact, this is where the result comes from, which is that, under some conditions, the optimal contract is going to be robust to the possibility of one-sided commitments, the possibility that the agent might want to leave later on, is because the contract is going to be naturally backloaded in terms of utility or front-loaded in terms of payments. And what that implies is that it's becoming more and more costly for you to leave. Given that you have a fixed outside option, it's becoming more and more costly for you to leave relative to stay in the original contract.
Mm-hmm. Okay. Well, and it's pretty cool paper. I mean, that was kind of, when you started it, I was like, wait, that no one has done that before. I mean, that should be, that seems very relevant, right? So
right. So it is a paper that's been around for quite a while. It was originally, in fact, my job market paper that has gone through many versions. And the main new things, which I think are kind of cool, are going to be the first, that I have the generalization now for realization dependent contracts. Originally only had results for the case of realization independent contracts, which is when firms can't actually use the income realizations explicitly. And this result of one-sided commitment, which I think is kind of interesting, because the literature on dynamic insurance, there is but there is this very seminal paper of Handel in this area. They look at the case of life insurance. They're looking at the case of symmetric risk information, but they show that if you look at one-sided commitments problem, there is a natural tendency to have front-loaded payments, as you were saying, which is that we would ideally would like to have two-sided commitment in ex-ante terms that would be optimal for the agent as well. Now we don't have that, so the efficient way to solve that is to front-load payments so that the agents will get locked in the contract. That's an indirect way of solving this one-sided commitment problem, and they show that this is indeed present in real world. They show empirically this is present in real world life insurance markets. Now, the point that I'm making here is that if you forget about one-sided commitment, there is already a natural tendency of these contracts to be front-loaded in terms of payments that has only to do with private information. So these two problems can be, in some sense, redundant. We can't actually say whether front-loaded payments is coming from private information or from one-sided commitment.